What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today's going to be a Q&A episode, so we're going to answer some questions that have come into us. So the first question says, I use QuickBooks Online and have a balance in my opening balance equity account. How does this happen? I don't understand. It was there at some point in the beginning. We thought we fixed it. Now it's there again. So what we generally see, what QuickBooks does, when you first connect your bank feeds, if there's a balance in your bank account, QuickBooks will pull that in and offset it with opening balance equity. That, I suspect, was the issue when you first started. You said you had this balance and it went away. So I'm assuming that's what happened. It was fixed. But now you have another balance in there again. So another common situation that we see that creates a balance here is you might connect a loan account or some other bank or credit card account. Maybe you bought a vehicle and recorded the loan and you weren't sure where to offset it. Sometimes QuickBooks will plug things there and you need to correct it with a journal entry. So we've seen before where maybe a business buys a vehicle, they buy a truck and they record the loan. They put the loan on the books and the offset goes to opening balance equity because they didn't record the asset or the cash outlay. So it sounds like it's something like that happened where there wasn't the wrong account was selected with a journal entry, or maybe you hooked up a new bank feed, credit card feed that's creating this issue. Those are the most common things that cause a balance to show up in opening balance equity. I should say, very good to hear that you're reviewing your balance sheet. We take a balance sheet approach with all of our business clients, meaning we review the balance sheet and make sure everything reconciles from the start. Then we go on to the P&L, because if your balance sheet reconciles, your P&L has to be correct on net. Now, maybe things are misclassified and that's part of the P&L review, but making sure your balance sheet is reconciled is good practice. You should be doing that ideally monthly, if not quarterly. So you want to make sure you have a good, clean, reconciled balance sheet, that's why good bookkeeping is so important. The cost of a good bookkeeper will pay for itself several times over in the long run. If you're just starting out and you have very minimal activity, is it really necessary? Probably not. But eventually, as your business grows, you're going to have to report a balance sheet with your P&L if you ever want to make an S election to be taxed as an S corp, or if you bring on a partner and now you're filing a partnership return, maybe you want to be taxed as a C corporation. So those corporate returns, those business returns report a balance sheet with the tax return. That's one reason those return types are audited less frequently, because the IRS can see that there's a balance sheet rolling forward each year with the income statement. When you report as a single member LLC filing as a sole proprietor on a Schedule C of your 1040, you're only giving the IRS a P&L. Without a reconciled balance sheet, they don't know if those numbers are made up or how accurate they are, if everything's being accounted for. So they have a much higher audit risk. That covers our first question. Next question we have here is, can I use my short-term rental hours to qualify as a real estate professional as part of my 750-hour requirement? Now, this is a great question. Technically, the answer is no. There's some court cases out there that support that. So there's two different court cases. Both happen to be named Bailey, no relation, where the court has ruled against the taxpayer and said that those short-term rental hours are not allowed to be included as real estate professional hours. So as a reminder, real estate professional status is one of the ways to get out of that default passive bucket for your rentals. And to qualify as a real estate professional, you have to show that you spent more than 50% of your time in a real property trade or business and at least 750 hours in a real property trade or business. Those are the two tests that you need to pass to qualify as a real estate professional. So if you have long-term rentals, midterm rentals, whatever you're using for those real estate professional hours. And then over here, you have a short-term rental or two. Those short-term rental hours are not going to qualify as part of your real estate professional hours, unfortunately. I don't agree with the IRS's reasoning here. I don't think that's correct. You're operating a short-term rental that to me should fall under a real property trade or business. But there are court cases out there, at least 2 that I know of, that have ruled against the taxpayers. So if you're going to take this position, no, it's risky. You may have to end up fighting it in tax court and hope you get a better outcome. Not for the faint of heart. That's very expensive to do. So the short answer is no, they are not going to qualify. Now, why would you want to qualify? Or why would you want those short-term rental hours to count as real estate professional hours, or the short-term rental itself? As a reminder, for short-term rentals, there is no, you kind of bypass the 750 hour requirement, and more than 50% of your time, you can deduct your losses with only materially participating in the short-term rental. That's what we sometimes call is the short-term, referred to as the short-term rental loophole. And it qualifies as a short-term rental. The average customer stay at the rental has to be 7 days or less. Then as long as you materially participate, you can take advantage of those tax savings. And the 7 days or less it's an exception to a rental, the definition of a rental under the passive activity loss rules. I suspect that's where the tax courts are leaning when they disallow these hours to count as real estate professional hours. So, but at the end of the day, your short-term rental hours are in one bucket and your real estate professional hours are in another, and they can't be combined to achieve that real estate professional status. You'd want the real estate professional status so you can deduct your long-term losses in addition to those short-term rental losses against your W-2 or business income on your tax return. Fortunately, we're not quite there yet. So play it safe and keep your hours separate unless you want to try to win in court. Now, our third question involves a 1031 exchange. So the question says, my qualified intermediary is telling me I cannot use an LLC for a 1031 exchange because it's a different entity. Is this true? For a bit of background, our relinquished property was owned in mine and my wife's personal names. We set up an LLC with just the 2 of us for purchasing the new property that we're going to receive as part of the 1031 exchange. So we wanted to go into this new LLC. Will that work? If not, is a qualified intermediary right? If not, why does this not work? As an alternative, we also plan to buy a new property and rehab it this year. Can we perform a cost segregation study and use bonus depreciation this year that will create a loss and help offset the gain from the sale of this property if we don't go the 1031 exchange route? The catch is the rehab work won't be done until sometime next year. Okay, great question. We actually have a couple questions here. So the first one, can we 1031 exchange into this new LLC? It's just the 2 of us, husband and wife. And the answer there is no. If you own the property in your personal names, you have to receive the new property in your personal names. You can't use a new entity. That is in the IRS regulations. Now, there's an exception for a single member LLC that's treated as a disregarded entity. It sounds like you have a multi-member LLC with you and your spouse, that's also going to trigger a partnership filing. So that's why your qualified intermediary is telling you that you cannot do this. Now, the second part of the question, if we forget about the 1031 exchange and we buy a new property and rehab it this year, can we use a cost seg with bonus depreciation to create a loss that'll offset the gain from the sale? That part alone, the answer is yes, you can do that. However, you go on to say that the catch is the rehab work won't be done until next year. So you can't actually depreciate the asset until it's ready to rent, placed in service. So if the rehab work isn't done until next year, unless it's some work that can be done while you have a tenant in place, then you're not going to be able to start depreciating the property until next year. Therefore, the cost seg study and that bonus depreciation isn't going to help you this year when you sell the property that you're considering doing a 1031 exchange with. I hope that helps. I hope that clears it up. That about does it for today's Q&A episode. I hope you found value in this. If so, please leave us a 5-star review or hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.